Hello, and welcome to Fiduciary Pension Partners Committee Training Module Number 1, Fiduciary Duties and Responsibilities. The purpose of this module is to help you in identifying the various individuals who are considered planned fiduciaries and to describe their duties and responsibilities under ERISA. Fiduciary Pension Partners is an independent investment advisory firm specializing in comprehensive retirement plan solutions. Our core services include plan design, tailoring strategies to meet your organization's unique needs, fee benchmarking, ensuring competitive and transparent fees, investment due diligence, quarterly monitoring of investment fund lineups, and employee education, offering educational webinars and complimentary one-on-ones. I will now pass it over to John Turk, and he's going to go into fiduciary duties and responsibilities.
Thank you, Michael. So as Michael said, the purpose of this module is to assist you in identifying the various individuals who are considered planned fiduciaries, and as well as to describe the duties and responsibilities for those individuals under ERISA. First, who is a fiduciary? It's any individual who has exercises control or management of the plan or the plan assets. Now, a plan may have more than one fiduciary, as well as within a plan, you can have an individual serving in more than one fiduciary capacity. As well as who is a fiduciary, it's important to recognize who is not a fiduciary. And that would be any individual who basically performs essential or ministerial functions, administrative functions to the plan. In a nutshell, it's an individual who does not exercise discretion or control. Every plan has to have at least one named fiduciary, and that's going to be described in the plan document. That may be the plan sponsor, an officer, board of directors, trustees, member of the management team or committee. In addition, fiduciary can allocate responsibilities to others if the plan document permits.
Fiduciary duties and responsibilities. The fiduciary definition is a functional one, which means anyone who intentionally or otherwise exercise discretion or control over plan assets, plan management, or administration becomes a fiduciary. Fiduciary versus settler duties. Business decisions related to the formation and design of a plan are not a fiduciary in nature. Fiduciary duties include implementing plan-related decisions, carrying out processes and procedures regarding plan management, acts carried out on behalf of the plan, and selection of provider, investments, or investment manager. Certain plan-related activities are considered non-fiduciary in nature, and those are called settler duties under ERISA. These include establishing a plan, deciding on the features that are going to be contained, and terminating the plan. Now, the implementation and management of these procedures are fiduciary duties.
Let's talk about co-fiduciaries. Co-fiduciaries are those to whom named fiduciaries delegate their responsibilities in an effort to better manage the plan. Now, fiduciaries themselves are not liable for the acts or omissions related to those delegated responsibilities, but fiduciaries do have a duty to monitor the co-fiduciary's performance of those delegated responsibilities. Board of directors or board of trustees are fiduciaries only to the extent that they function as fiduciaries to the plan, in that they have discretion or exercise control. Benefit and investment committees are fiduciaries if delegated fiduciary responsibilities. A best practice for committees is to adopt a committee charter, as well as have a policy for maintaining written meeting minutes that would describe those actions taken and how each fiduciary voted. Now, members can resign in protest to a fiduciary breach of another member of the committee. However, that resignation may not be sufficient to discharge reasonable efforts to remedy those duties. there may be other necessary steps necessary. Action steps that we recommend that a committee take is to prepare board resolutions delegating fiduciary responsibility to committees or individuals. That includes adopting a committee charter, as well as soliciting acknowledgement of committee members for the appointment as well as their resignations. And of course, you will want to keep a copy of all committee-related documents, minutes, resolutions in your fiduciary file.
So trustees are fiduciaries due to their ability to manage and control assets. There are two types of trustees. Discretionary trustees. These people have complete authority and discretion for management and control of plan assets. There are also what's called directed trustees. Directed trustees only have specific responsibilities that are directed to them by the named fiduciary. An investment advisor is a co-fiduciary, assuming the advisor meets the requirements in ERISA Section 321. Section 321 of ERISA defines a fiduciary refers to fiduciary as an individual who renders investment advice to the plan in exchange for compensation. New and pending legislation may expand this definition of an investment advisor as a fiduciary. An investment manager is a fiduciary if they meet the requirements of ERISA Section 338. A 338 investment manager under ERISA must acknowledge their responsibility in writing, and they generally can be a discretionary trustee because they do have complete control over assets. This means that a 338 can select, monitor, and replace investments for the plan, while a 321 investment fiduciary has to wait for approval for such decisions. A 338 can go ahead and make these decisions on behalf of the client. This is why a 338 investment fiduciary must be a registered investment advisor, RIA, under federal or state law, a bank, or an insurance company.
Now, your plan may hire outside attorneys, professionals, accountants, consultants to assist in the performance of the plan. Generally speaking, these professionals performing their usual professional functions are not fiduciaries. They are, however, considered a fiduciary if they have any discretionary authority or control over the management of the plan or render investment advice for a fee. They also become fiduciaries when plan fiduciaries themselves rely on their advice when making fiduciary decisions. Employees are generally not plan fiduciaries, but can be, depending upon their individual facts and circumstances. There are prohibitions for folks to be a fiduciary, and those would be a listing of those that you see here if they've been convicted or imprisoned as a result of said legal action, and you can see those here. An important action step for committees is again to have a complete list of fiduciaries within that fiduciary file, where you're going to identify all the fiduciaries along with their appropriate responsibilities.
ERISA Section 404A identifies the basic fiduciary responsibilities. The golden rule fiduciary behavior is to always act solely in the best interest of plan participants, their beneficiaries, and all alternative payees. In doing so, a fiduciary must act prudently, follow the plan document, diversify plan assets, and pay reasonable expenses. The duty of prudence. The duty of prudence is not a common person duty of prudence or a common definition. It's a heightened definition to that of a prudent expert. So when acting on behalf of the plan, this prudent expert fiduciary must exercise care, skill, prudence, and diligence that a prudent person familiar with such matters would exercise in similar circumstances. For example, an expert. Plus, with regard to investments, they must give appropriate consideration, which we will cover in a minute, to the facts and circumstances that they know or should know are relevant to a particular investment decision or investment course of action. Note that the Department of Labor and courts measure prudence by analyzing the process used to select an investment or course of action. This is called procedural prudence, and you will find out more information on that in our fiduciary fitness program.
Now, Michael mentioned appropriate consideration, and let's provide a definition of that. Appropriate consideration includes a determination that a course of action is reasonably designed to further the purposes of the plan, consideration of the risk of loss and opportunity for gain associated with said course of action. And in speaking with regards to investments, you'd want to take into account the composition of the portfolios with regards to diversification, liquidity and current return relevant to plans' anticipated cash flow needs, as well as a portfolio's projected return relative to funding objectives. For fiduciaries, it is important that you be familiar with the plan documents and the terms of the plan documents, as well as the summary plan descriptions, as well as administrative procedures. Carefully review the documents periodically to ensure that they are legally compliant and meet the administration in terms of the plan documents with ERISA and the Internal Revenue Code, as well as any other applicable laws that might apply.
Another duty of a fiduciary is to diversify investments. The main responsibility is to help minimize risk of large losses. A fiduciary can take the following into consideration: the purpose and size of the plan, economic and market conditions, the type and geographic dispersion of the investment. Relying on information from others. Fiduciaries may rely on information provided by individuals or other entities performing ministerial functions for the plan, but must exercise prudence in selecting or retaining an individual or entity. A good example of this would be the selection of an ERISA 316 vendor. Appointing trustees or other fiduciaries should not be appointed based on their corporate position alone. The appointment should be based on their expertise, experience, and what they have to contribute to the management of the plan. Fiduciary terms are indefinite, which means a fiduciary cannot resign from their fiduciary duties unless they do so in writing, or they are retiring from the company or terminating from the company. The named fiduciary must monitor performance routinely, identifying all fiduciaries, outlining their responsibilities, measuring performance, reviewing any complaints, utilizing a documented process, and annually reviewing the activities of the committees. Here, we would recommend the committee report to the board with a named fiduciary on an annual basis. Immediate steps must be taken if there is any fiduciary deficiencies or terminations that are consequential to the plan.
Fiduciaries have duties and responsibilities around reporting and disclosure requirements. Fiduciaries must comply with ERISA's reporting and disclosure requirements. These reporting requirements can be met both electronically as well as non-electronically. And some examples include a summary plan description as well as fee disclosures. In addition, fiduciaries must be covered by a fidelity bond. This is not insurance. And this is every fiduciary and anyone who handles planned funds or property must be properly bonded unless subject to an ERISA Section 412 exemption. The fidelity bond must cover at least 10% of the amount handled by the individual and may not be less than $1,000 or the greater of $500,000. For plans that hold employer securities, that maximum is $1 million. In terms of the action steps, establish a prudent process to comply with ERISA duties, conduct administrative audits to confirm the plan is operating in compliance with plan documents, ERISA and IRC codes, and confirm that the appropriate fidelity bonds are in place. In conclusion, we've created a chart to determine if an individual is a plan fiduciary. The first question is the individual in the plan document or through a process described in the plan document as having authority over plan operations? If you answer yes, they would be a plan fiduciary. Does the individual have or exercise discretionary authority or control over the management or disposition of the plan assets? If the answer is yes, they're a plan fiduciary. Does the individual have or exercise discretionary authority or control over the management of the plan? If the answer is yes, they are a fiduciary. Does the individual have or exercise discretionary authority or responsibility in the administration of the plan? If that answer is yes, they are a fiduciary. And then lastly, does the individual render investment advice to plan fiduciaries for a fee, directly or indirectly on a regular basis, pursuant to a mutual understanding that that advice will be individualized based on the needs of the plan and will serve as the primary basis for the plan's fiduciary investment decisions? If that answer is yes, that individual is a plan fiduciary. That concludes our discussion of fiduciary responsibilities and roles. Thank you for your time. We hope you found it informative. If you should have any questions or we can be a resource, feel free to reach out to us at either 908-224-2377 or email at info@fiduciarypp.com. Thank you for your time.